Hello and welcome. I'm Real Crowd CEO Adam Hooper, and this is the Real Estate Investing for Your Future podcast. Here we explore the latest in commercial real estate trends, insights, and investment strategies that passive investors can use to build real estate portfolios that last.
All opinions expressed by Adam, Tyler, and podcast guests are solely their own opinions and do not reflect the opinion of Real Crowd. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. To gain a better understanding of the risks associated with commercial real estate investing, please consult your advisors.
Our guest today is Beth Burnham Mace, Chief Economist of the National Investment Center for Seniors Housing and Care. In today's conversation, Beth discusses the fundamentals of senior housing, the current state of the market, and factors that investors should be paying attention to. Be sure to check the show notes for links to learn more about Beth and everything that Nick is up to. We hope you enjoyed today's episode with Beth Burnham Mace. Well, Beth, thank you so much for joining the show today. We're excited to have you on. It's been a interesting time in the senior housing space, so we're excited to have you on and shed some light on what's going on in the industry. Thanks for joining.
Well, Adam, thank you for having me. I'm glad to be here.
Yeah, so before we jump in, why don't you tell us a little bit about your background in real estate and more importantly, what led you to NIC?
Sure. So let's go back, roll the clocks back a bit. So I graduated from Mount Holyoke College, and then I went to graduate school at University of California, where I earned a master's in applied economics. And I've essentially taken that applied economics degree and over my career applied it to various industries because the concepts are essentially the same. Mm-hmm. Supply, demand, pricing, things like that. And I've applied that to banking and utilities, commercial real estate, and then eventually senior housing. So I started at NIC actually on its board about 15 years ago. And NIC is the National Investment Center for Seniors Housing and Care, also known as NIC. And it's a not-for-profit organization with the mission of trying to create more housing and care options for older adults. Mm-hmm. And we do that by bringing together capital and those who need the capital. So banks and lenders and equity groups along with the operators and developers. So while I was at AEW Capital Management, where I worked for about 17 years, I really developed an expertise in senior housing. As AEW was actually one of the first institutional investors in senior housing. And back in those days, we didn't have much data, and you had to do some primary research. And eventually that brought me to be really interested in staying involved with senior housing because it's an industry that you actually can do good by doing well or do well by being good or any phrase like that. And so I've been at NIC now for about 8 years on staff. But prior to that, as I said, I had worked on the board for about 8 years as well. And
so was there something about that industry that pulled you in? I mean, obviously, it sounded like you said you're doing good by doing well, and I think that's certainly something that, as we look at the population, there's much more of a need for that in these days. What was it about the senior housing industry that really pulled you in and has taken to where you are with NIC?
Sure. So within real estate. You're looking at supply market fundamentals, demand fundamentals, and, that might be for multifamily apartments or it might be for office buildings. But with senior housing, I can apply all those same concepts, but to something that actually is making a difference in someone's daily life. And most of the people I've met in the industry actually are really nice people too. So they're, everybody's out to make, a profit for sure. But these are people that are in the industry because they really care about helping older Americans, and so that's a really nice aspect of it.
And so, Chief Economist and Director of Outreach, what does your day-to-day look like when you're looking at the macro facts, and what sort of data are you looking at when you make these decisions or kind of policy guidelines?
Right. So NIC actually is, I call it like the Commerce Department of senior housing data because we collect raw primary data from operators and from individual properties. So we collect information about, how many units do you have, what's the inventory, what's the occupancy, what are some of the challenges facing you within the industry. So we collect the primary data through different surveys and data collection. So I spent a lot of time looking at the data and assessing it, and it's pretty fun from my point of view because we have the first look, so to speak, so we can really focus on the industry itself in terms of supply and demand fundamentals. And then I get to report that out to the industry broadly. And I also get to hear firsthand from a lot of operators and developers and those who finance the industry on what the challenges and opportunities are that they're seeing.
Right.
And so that's really fun too, from my perspective, to hear it and then process it, digest it, think about it, and then write about it and speak about it.
And now, so let's dive in a little bit more there. From a 50,000 foot view, most I think would look at the senior housing space as this kind of homogenous product, right? That's a blanket asset class that is senior housing, and maybe not necessarily appreciation for the different levels of care and different operating models. So maybe help us understand, under the umbrella of senior housing, what are some of the different aspects, I guess, of the different care levels, and how do you look at maybe differentiating one facility from another?
Yeah, that's a great question. So you can think of it as a spectrum of care. And at the lowest end of care needs, or the lowest acuity levels, would be what we would call independent living. An independent living product would really be similar to an age-restricted apartment, but it would provide you housekeeping, it would provide you some meals every day. Next to that would be what we would call assisted living, which would include everything I just described, plus care for what we call activities of daily living. So maybe you need help with medication management, or with dressing or bathing or showering. So that would be assisted living. And then next to that, sort of higher acuity typically would be memory care. And that would be aimed at folks with dementia or memory care issues themselves. And then beyond that would be sort of skilled nursing. But for senior housing, typically we think of that as private pay, whereas skilled nursing is often government reimbursed.
Okay. And I think that's one of the maybe challenges from the kind of pure real estate mind, is looking at this, because oftentimes there is an operational component versus say a multifamily complex or an office building, or some of the other asset classes, right, where it's just a pure real estate play, and you're leasing spaces to tenants, and there really isn't like an active operating component, right? Whereas sometimes in the hospitality space we'll see that, and mostly, certainly as you get in those higher levels of care, there is an operating component. So as a potential investor, passive investor, which most listeners on this podcast are, how should they think about looking at that from the real estate component and the operating component, and how do those kind of play together in this asset class?
Yeah, that's great. I mean, the closest thing you might have to this is maybe a hotel a little bit, because there is an operational component to it. But the care needs are obviously more significant for like assisted living, for example. So the operator is key. So in my career, I've underwritten hundreds and hundreds of senior housing deals, and it's not just the real estate, it's not just the location, it's really the operator and how well that operator serves the residents. And you could have what would pencil out to be a fantastic property in terms of its location, in terms of its competitive set, in terms of, if you look at the revenues and the expenses. But that might strike out if you don't have a really good operator there. So there is no single statistic, so to speak, to look at operator quality.
Yeah.
But anyone who invests in senior housing, there's a fair amount of due diligence where you walk around the property, you meet with the operator themselves, or a lot of the institutional investors would have long-term relationships with those operators themselves to understand what their strengths and weaknesses were. And, a good measure is looking at the occupancy level, looking at referral rates, how much of the new residents coming in are there by referral from the existing resident base, a few tricks like that you can help get a gauge of how well the operator is doing.
Yeah, that's really helpful. Do you generally see a bifurcation between the real estate developer, owner, and operator, or are those usually one and the same?
It can be all sorts of different structures. So you might have a developer who is good at working with the getting the contractors and things like that, and figuring out how to get the land entitled. who may be in and of themselves, or you might have a developer who is in itself the operator as well. And in some instances, you actually have the owners as well as the operators being one and all the same. So I think there's no secret sauce. There's a lot of, depending on what the individuals involved really prefer, you're going to see different structures like that.
And how big is the senior housing market right now? I mean, I think we've seen only a handful of deals on our marketplace over the years that have been in that asset class. I think it's been one over time. I think generally there's and we'll talk, I'm curious to dig into some of the data a little bit more about kind of supply and demand drivers, but I think obviously our population is aging. Everybody understands that. I think there's an understanding there is a need for more facilities, but how big is that market? And I guess maybe what have you seen in terms of transaction volume or new facilities opening up over the last 5-10 years?
Sure. It's definitely a growing industry. It's valued right now at about $437 billion. $437 billion. It's comprised of about 3.1 million units. And when I'm talking about that, I'm talking about like institutional quality, market rate type properties. So 3.1 million units, about 25,000 properties. Half of those are nursing care properties. And then you can split the rest up into independent living, assisted living, and memory care, and what we call CCRCs, or continuing care retirement communities. Increasingly, gosh, I've been involved in this industry for more than 20 years, and increasingly it's becoming more of an institutional asset type with large pension plans, now more involved, CalPERS, CalSTRS, all the New York STRS, all the big pension plans have at least touched their toe into the water here of senior housing. It's tracked by something called NACREIF, which is the National Council of Real Estate Investment Fiduciaries, which looks at all commercial real estate. So it's tracked by that. We have over almost 20 years of data tracked by NACREIF for senior housing. Two very large public REITs, real estate investment trusts, are involved. Those would be Welltower and Ventas. It's tracked by Wall Street analysts, and so if I go back 20 years ago, most of what I just said wasn't true.
Right.
But today it is true. So it's definitely become a much more acceptable real estate investment asset type in which to invest.
Yeah, and I'm curious the composition of that capital, right? Most of what we see on our platform are syndicators, and smaller institutional managers that are out, doing private capital raises, either from friends and family, and in some cases, smaller family offices, smaller institutions. What is the nature of capital for most of these projects? Is it regional managers? Is it, again, you said a couple of the larger REITs that are out there, but is it from a manager and I guess typical capitalization? What does that usually look like?
It's sort of all the above in the sense that it's got some, as I said, large institutional investors, and those are usually that capital that would be coming from a pension plan is usually managed through a group like where I worked at AEW Capital Management or a PGIM or Harrison Street, groups like that. But there's also, in fact, I was just on a call earlier today, that there are also some small family businesses that are involved in this industry as well. And those you typically see the investors with the family money investing in one or two managers or one or two operators. And those operators in turn, building a relationship with those family managers. I was just off a call a few minutes ago, and there was one, fairly significant investor in the industry, but he's got 3 or 4 sources of family capital, family office capital that have been investing that. And then you have, the large institutional groups that are, involved with the pension funds, and then you have the public REITs that are, on the public exchanges, so that they're raising capital that way.
And so then you look at a little bit more on the demand side, touched on just general demographics, aging population. When investors are maybe looking at markets that these assets are located in, what are some of the demand drivers, I suppose, that you're looking at from a data perspective or demographic perspective that make a market attractive versus another?
Yeah, so obviously the depth or the density of seniors in a market, and typically you look at households or individuals over 75. But what might surprise some folks is that it's really important to look at the adult children as well. So the adult children in this case would be those who are 45 to 64-year-olds. Those are the children of the parents or the people that would be living in senior housing, which is typically 80 and older. So often see the residents of senior housing move to be close to where their children are,
Yeah.
or to be close to where their grandchildren are. And usually it's an incident. Maybe the adult child notices that the stove hasn't been turned off, or there's some hazard that's not being taken care of properly, and so that will prompt them to try to urge their parents to be closer to where they are. So it's a combination of both of those. So in terms of demand drivers, the strength of a local economy is important, because if it's the adult children, you want to be in a market where there's good job generators, job incubators, things like that. And I think importantly, so it's the demographics, it's the density and the size of the seniors as well as the adult children.
Mm-hmm.
And then that's on the sort of the demand side. And then the supply is really, really trying to track the existing competition and what the potential competition might be in the market. It's the same for any commercial real estate asset type, right? You want to look at the demand supply balances as well as you can. And another factor might be to really look at what I would call the penetration rate in a market. So how much senior housing exists for, normalize it by the number of people who are over 75 or the number of people who are over 80. And you could argue that a high penetration rate is actually good, in the sense that people understand senior housing as part of the continuum of your life, that you work, you retire, and eventually you may want to move into senior housing. And in markets where the penetration is high, such as Minneapolis, you see the occupancy rate surprisingly stronger than in a market that has a lower penetration rate, because the product isn't as familiar. It's not as commonly viewed as part of the lifestyle of what happens as you get older. So that's an interesting nuance in the sector.
Yeah, I think the point of I wouldn't have thought to look beyond just the older population, but the children of that, right? I think that's an interesting factor of that familial connection when it comes to that stage of life. Are they going to stick closer to the children, or they're stick more where they've been located primarily? That's an interesting one.
Yeah, and in fact, there's a phrase now. It's called baby chasers. So it's the grandparents that are like running after to see where their children and their grandchildren are. And the other factor that's really important, that certainly wasn't a factor 10 years ago, was the labor force. And, with the national unemployment rate, 4% and falling, it's not just unique to this industry, but, all industries right now are having a hard time getting workers. And in less dense or more rural areas, it can be challenging to get the type of worker that you really want to be involved with senior housing, because it's not anybody that can really do this job. You have to be someone who has, a strong heart and care and really want to help others. So labor force is a factor that can make or break senior housing market right now.
And so then when you switch around and look at the supply side, are there similar dynamics, I'm assuming, to what we're seeing in the multifamily space, right? Very difficult to deliver any new product that's not super high end, just due to construction costs and supply chain issues and development time and land costs and entitlements. How do you look at maybe stratifying class A, B, C? Is there a similar metric that you look at in the senior housing space? And what does that supply pipeline look? Are there older facilities that are being renovated? Is there a lot of new supply coming online from ground up developments? Maybe walk us through what that supply side looks like.
Yeah, so it's interesting. I think the senior housing industry is maturing. And what I mean by that is that you're seeing a more broader differentiation, both by rate or price point, as well as by the level of service or the acuity level. So a few years ago, NIC produced a study called The Forgotten Middle, where we really tried to quantify the number of individuals in the U.S. have middle income levels that couldn't really afford today's senior housing product. And it's a big number. It's like 14 million people by 2029 will be in that category of older adults. And so we're starting to see more attention being focused in on how to supply the housing and the care that's required for aging seniors. So that's a huge opportunity. I don't think that anybody's quite figured out the secret sauce in terms of how to do that at a profitable pace as well. But you also then see sort of what I would call sort of the today's senior housing, which sort of serves the higher middle income to wealthier client base. And so that's sort of the mid-tier point, I would say. And then you're also seeing products being developed now for the what I would call the uber wealthy, that can go, nosebleedingly high monthly rates that you're seeing show up in some pretty high density, wealthy urban areas such as New York, Manhattan, San Francisco, parts of Houston, and Boston, that they're playing after, the people who really want concierge services, want things brought to them, high technology, high service, high end as well.
Style.
So,
yeah.
Right. So there's a whole stratification that's going on in the industry, which to me is really exciting because it presents lots of opportunities, some challenges, but lots of opportunities to sort of find the niche that you want to work in. Is it a tertiary market, primary market, secondary market, and who it is that you're trying to target in terms of your client base?
So let me just make sure I got these numbers right. So you said there's, by 2029, 14 million people that are in this kind of middle tier. The total market size right now is 3.1 million units, half of which are skilled nursing. So we're 12 million units short, roughly. Is that?
No. I wouldn't. You wouldn't assume that all those 14 million people will be.
Okay. So what percentage?
No.
I'm like, where is the? That seems like a massive imbalance there, right? Even if you assume.
Well, there's a great need for housing options, and the fear, of course, or my fear, is that people will spend down to become eligible for Medicaid if they can't afford housing and care for themselves, and that certainly isn't a good solution for us in the long run as a nation. So we really need to start to address the need for housing and care for middle-income seniors. And if anything, during the pandemic and everything, probably the need is even greater. For that type of product.
Well, so let's maybe explore that one a bit. Coming, again, we're recording this early 2022. Hopefully, fingers crossed, on the other end of this pandemic, becoming closer to endemic. Early on, the senior housing industry got a lot of heat from what was going on, and I think from an investor's perspective, certainly a lot of investors, just from that headline risk, were really turned off from the industry. What would you say kind of the state of the market or the state of the industry is now, where we're at in the pandemic? Maybe what's been learned since then, and how you see that going forward as we look past this?
Sure. So first, I think it's important to differentiate, as we were at the beginning of our conversation, between skilled nursing and senior housing. And a lot of cases and a lot of fatalities occurred in skilled nursing. And that kind of makes sense because, unfortunately, as we know, this pandemic really targeted older people. And by definition, a lot of older people live in skilled nursing, and you live in skilled nursing when you're particularly frail. So it was a population that was very susceptible to COVID, unfortunately. So we've done a study that looked at and tried to differentiate the outcomes and fatalities for skilled nursing versus senior housing. And for independent living, for example, we found that the same mortality rates existed in independent living as existed in the general population. So that isn't necessarily what most people think about or see when they think about seniors housing, but it did differ depending on the population that typically is within an independent living, assisted living, memory care, or skilled nursing. So that would be one point.
And I think, like you said, that goes back to I think, again, people that aren't specialists in this asset class. And again, this conversation today helps illuminate that, right? It's not just one umbrella of senior housing, right? There are those different tiers of care. And I think maybe a correlation, not causation, is what you're getting to there, of looking at it's not just senior housing that had a disproportionate amount of mortality in the pandemic. It was just that age of the population is what got affected the most. That happened to be a subset of the senior housing, right? Not the entire industry.
Right, exactly right. Now that said, the industry was definitely negatively affected and hurt by the pandemic. I mean, there were moratoriums that were put in place early on and back in April 2020, April, May. It seems long ago, yet so close at the same time. So there was moratoriums put in place, and some of those moratoriums were mandated by local or federal or state government, but some of those moratoriums are also self-imposed. Most of the operators of senior housing and skilled nursing, they wanted to keep their residents safe, right? So they proved to be, in my view, incredibly agile. If you go back to that time, nobody knew whether this was airborne, whether it was surface borne. You couldn't get PPE, the protective equipment for people. You couldn't get testing. It was a really difficult, challenging, very, very difficult time. So it was hard for the industry, and the industry lost a lot of occupancy, and the occupancy rates fell quite sharply for senior housing, down almost 8 full percentage points during COVID to levels that hadn't been seen before. And that had more to do, sort of the same with apartments or hotels. There's a front door and a back door. So you want to bring people in, and then you don't want them to exit, or you want them to stay, have as long a length of stay as they can. For seniors housing during the pandemic, it was more of a front door issue. Mm-hmm. Because operators were bringing people in again for safety reasons. So if they brought them in, they had to go quarantined for a long time. Pretty soon after, well, I don't know, it depends on the definition of soon, I suppose. But, within several months, the whole idea of quarantining and isolating residents became really understood that wasn't probably the best option. Because what increasingly is understood as part of the value proposition of senior housing is actually the socialization aspect of it. Mm-hmm. And we know that, risks of isolation, there's studies out there that show like if you're isolated for a long time, it's equivalent to smoking, 15 cigarettes a day, or, I don't know where they got that stat, but there's a stat. So so it's bad for you to be isolated and for you to be lonely. And that's one of the real value proposition pieces of senior housing, is that you don't have that. So you saw a shift after a few months of the pandemic to try to make sure that there was still socialization and interaction mm-hmm. between people to the degree that you could. So you saw, in warmer climates, you saw outdoor living rooms, so to speak, or you saw plexiglass being put up to keep people breathing. Again, once we realized that it was more of an airborne versus a surface-borne illness, that changed some of the parameters of how you could care for people as well.
Mm-hmm. And so now, 2 years on from that, how has the industry recovered or reacted from some of those lessons learned?
I'm happy to say that the industry is recovering, and we're starting to see, in fact, I have data that goes through the fourth quarter of 2021, and the fourth quarter and the third quarter of 21 were the strongest demand quarters in terms of move-ins, in terms of absorption or mm-hmm. occupied unit growth that we've had ever on record.
Wow. So
there was some pent-up demand. And I think that, again, that sort of the value proposition of seniors housing, you have safety and security, but the socialization and the engagement, lifestyle choices started to become more desirable, and people really have been moving in. Now, that said, again, that's great, and the occupancy rates are higher, but they're still well below where they were going into the pandemic. So mm-hmm. there's still a ways to go before we get back to those levels again.
Yep. So would you say overall right now, bullish on the prospects for the future of senior housing?
I would say I'm cautiously optimistic. We certainly, I
found myself, we've been using cautiously, I think we've been using that for about 8 years now. I think we're cautiously,
well, it's still,
that's just a general.
Cautiously. Well, we have the demographics that are certainly coming to us. Everybody's been waiting for the baby boomers to get to the age of wanting to mm-hmm. move into senior housing, and we're getting closer. We're not quite there. The oldest baby boomer in 2022 is 76. Mm-hmm. So if the typical age is 80 to 82 that you are in senior housing, you still have a ways to go on that. But it's definitely moving in our direction. We had a bit of a pause in the supply pipeline related to the fact that a lot of construction debt wasn't available early on in there, June 2020 to probably June 2021. So that mm-hmm. slowed down inventory growth. So that's going to help support occupancy rates. So in the long term, I'm very bullish, but, I'm an economist, so I keep looking, oh my gosh, now what's happening? Now today's threats are, well, obviously what's going on in Ukraine with Russia, in terms of the impact that can have on supply chains and inflation. That's a big concern of mine right now is inflation and what happens, especially to individuals who are on fixed budgets, which many seniors are on fixed budgets. So how do you address that? And then how do, just a simple increases in labor costs are affecting operators and their ability to maintain any margin.
Right.
Insurance costs have gone up. So it's, I would say we're not out of the woods. There's still a lot of challenges that have to be overcome, and labor among them is a key one. But the demand drivers are, I think, in place, which should support future growth in the industry. And I'm especially excited about the prospect of figuring out how to provide housing and care to the middle income cohort, because that's a big untapped opportunity. And
now you mentioned there again, we're recording this right in the midst, early days of the Ukraine conflict. How, from a market or maybe more macro perspective, how insulated or impacted are markets for senior housing product? Obviously it sounds like the economic engine of a local market is very important, but what are some of those more maybe macro, national, are there global factors that are impacting this investors can maybe be thinking about?
Yep. So I think consumer confidence is really important. And there was a recent survey just put out by Suffolk University that consumer confidence, and also the University of Michigan's consumer confidence survey, that showed that consumer confidence is very low right now. People are feeling pretty timid about where we are, and largely that's related to inflation. It seems in America or the U.S., it seems like the price you pay at the gas pump dictates an awful lot about consumer sentiment. And with oil prices, going above $110 a barrel earlier today, gas prices are going to go up, and that doesn't make people feel real good.
Right.
So I think that consumer confidence is really important. I think a sense of wealth that people might have from the stock market, which obviously isn't so great right now, also has an impact. But overall, other statistics to sort of track would be housing. And people often use their house, the equity from their homes, to help pay for some of the needs that they're going to have for care and housing as they get older. So home prices right now we know are quite strong. So that's bullish as well. So I pay attention to, labor markets, again, I said were really important. So I pay attention to that, consumer confidence, home prices, the velocity of home sales, and things of that nature.
Yeah. Are there any other higher level metrics that investors should be paying attention to? And then also maybe a little bit beyond that, where can investors find or track this information?
So there's lots of free content on NIC's website, which is www.nic.org. We have regularly updated blog posts.
That's nic.org.
Right.
Yep.
We have blog posts, a newsletter, podcasts, lots of things that you can get for free. So I would say that it's important probably to track the overall performance of the sector. And as I said, it is improving today. But you need to drill down into an individual market and into an individual property and into like a 5-mile primary competitive market area around something to really make sure that you understand. And one of the best ways to do that is to really track what occupancy is doing at like the competitive set. And that's information, again, that's available through NIC. But you can also get that by walking a property and walking the competitive set yourself. If it's a family investor, to do that. So you need to do your homework as you do with any kind of investment, really. You can do a desktop, but you also, in my view, you also need to, if you can, really understand the local market, because there's no markets that are the same.
And are there any data points or stats or metrics that you're looking at more closely now coming out of the pandemic that maybe have a better understanding for, or surprises that you saw during the pandemic? Anything interesting that came out of that you're paying attention to now?
Well, we've been paying close attention to the incidence of case counts at the skilled nursing and senior living property. We've been paying close attention to vaccination rates. Fortunately, this is a few weeks past the peak of the Omicron. I'm glad I'm talking to you today.
Yes, yeah.
So it looks like a brighter horizon right now, but I'm still nervous about if there's a new variant or something like that. But that said, I think that there's been a lot of lessons learned during COVID, by operators and how to keep people safe. And I don't think that's going to go away anytime soon. So I do feel pretty comfortable that even withstanding, Omicron was pretty tough, right?
Yeah.
But that had more impact for operators actually on labor than it did on the residents themselves, because there were a lot of absenteeism and sick time that was taken during that. But the residents themselves, the occupancy rates really, at least so far, doesn't look like they were very affected.
Yeah, and I think we saw that across all the labor markets, right? I mean, I'm just thinking here locally, even just with kids in school, right? There was such a shortage. I mean, we had some bus routes and kids weren't getting dropped off until 5:36 at night with the shortages. So I don't think I think that was a pretty widespread labor impact on that one.
Yeah, we seem to be hopefully coming out of that.
Yeah, fingers crossed. Well, Beth, this has been a really, really great conversation, a ton of really good information again. Really appreciate you coming on today. As we round it out, a couple questions we always ask. Where we're at right now, again, everything going on that we talked about, what are some of the factors or concerns that are keeping you up at night as it relates to this asset class?
I would say that I spend a lot of time looking at individual markets, and there are some markets in the U.S. that are oversupplied, that have particularly low occupancy rates. There are some properties that are suffering with pretty low occupancy rates, so I worry about those properties. And I particularly worry about it because it's not just properties. We're talking about people, right?
Right.
And these are older adults, so it makes me, I do worry about that. That makes sure that those people are properly cared for. So that's one thing that would keep me up at night. And then the broader just economic impacts on the sector, I would say as well.
And then converse to that, what has you most optimistic about the space?
Well, demographics, for sure. The demographics are coming at us. And very excited about the use of technology in this space. It's changing it. That people have Alexa now in their rooms, and they can call on Alexa to do lots of things. Lots of labor-saving devices that are being developed through technology. So that's very exciting. I think there's all sorts of new and really cool architecture and engineering designs that are coming about, partly because of COVID. And so the product is continually evolving. And we have this huge, unserved market yet, this baby boomer generation, and they never do anything like their parents did, right? So I think that it's going to be really fun to see how the influence that they'll have on this sector, and we don't know what that is quite yet, but what we do know is that this baby boomer generation is much more involved and doesn't want to just sit back and coast. They want to be involved. They want purpose. They want meaning in their life. They want lifestyle changes. They want to really equate their lifespan to their health span to their wealth span, and match all those. So wealth, health, and lifestyle and lifespan. So I think that will be really fun to watch how that emerges.
Yeah, so that's actually an interesting one. I mean, we've talked about it a lot on the show of like looking at office, for instance, right? Coming out of the pandemic, how we use that space is very different, right? And I think what you just mentioned there, how the baby boomer generation is going to want to use that environment is very different than the generation before, which, I mean, is that mostly going to be retrofit? Is that technology coming in? Is that a totally different use of the space? When you think about common areas, you think about, what are those things that make it an attractive amenity for the baby boomer generation, as opposed to the prior. That seems fascinating.
Yeah, no, it is really fascinating. And I was on a call earlier as well today, talking about there's a particular operator who's requiring people when they move into the properties to volunteer like 2 hours a week. And you might go, And it turns out she has incredible amount of waiting lists to get in there, because people are attracted to her property because there are people that live there that like to volunteer. So people want to be with that. And they also, and they also view it as an opportunity to not be lonely, to get involved right away. So I thought that was pretty fascinating. And so that would be a pretty remarkable difference, I think. And I don't know if that's generational, if that's just this one property, but it is something really interesting to think about, because I think that the baby boomers do want purpose. They just don't want to be sitting and playing golf all the time. They want to have some meaning in their life, and volunteering might be one.
I'll be fine just sitting and playing golf all the time. I'll just put that out there. Yeah. That's what I'm looking forward to.
Well, we'll ask you when the time comes.
Yeah. Well, that's super interesting. And I think, I mean, again, there's a million different ways that technology is affecting real estate as an asset class in general. So it's good to hear that there's a lot of innovation going on and ways to solve some of those unique problems in the senior housing space too. It'll be interesting to watch for the next decade or so.
Yeah, I totally agree. So just one last comment. There are institutions that just focus on technology and aging. For example, MIT has an aging lab where they just focus on that alone. And there's other universities and schools that are focusing on the use of technology to make the aging process better and to help, especially in this time of labor shortages.
Yeah, that's good. Well, Beth, again, really appreciate you coming on today. This has been an area and an asset class that we wanted to dig in much more on, and I think your listeners will certainly get a new appreciation for some of those nuances. So really thank you genuinely for coming on and sharing your time with us today.
Totally my pleasure, and good luck.
Yes, and we'll put links in the show notes, but again, real quick, best way for them to learn more about what you're up to with NIC and how they can get access to that info?
www.nic.org.
Perfect. And again, we'll have links in the show notes. Beth, appreciate it. Thank you.
All right, thanks for having me. Bye, everyone.
All right, listeners, that's all we've got for today. As always, if you have any questions or comments, send us a note to podcast@realcrowd.com. And with that, we'll catch you in the next one.